हेलो स्टूडेंट्स, वेलकम टू सागर शर्मा क्लासेस। आज हम आपके लिए लेके आए हैं फाइनेंशियल मैनेजमेंट का एक इम्पोर्टेंट टॉपिक। इसमें हम आपके साथ डिस्कस करने वाले थ्योरीज ऑफ द कैपिटल स्ट्रक्चर। सो लेट्स टेक अ ब्रीफ इंट्रोडक्शन ऑफ दिस टॉपिक। फर्स्टली, this is the topic of the capital structure. So firstly, you should know about the capital structure. Just wait, we will take a pen. Yes. So what is the capital structure? Capital structure is nothing, just a debt equity mix of your firm. Basically, if your firm has a total capital of 10 lakh rupees, so 10 lakh comprises of debt and how much equity, that is your capital structure basically. So there are various theories given by the various financial analysts. So what are those theories? First, look up these. Yes, you can see there are four mainly theories of capital structure. First one is net income theory, net operating income theory, traditional theory, and Modi, Giuliani, and Miller MM theory. Firstly, you should know net income theory and traditional theory is talks about the relevance approach, and net operating income approach and Modi, Giuliani, and Miller MM theory is based on the irrelevance approach. So, what is this relevance or irrelevance approach exactly? This is nothing. This says if your capital structure uh, decides the impact on cost of capital, so that is your relevance approach, and that the irrelevance approach says your capital structure does not impact your cost of capital. So one by one we will discuss all the theories. Firstly, see net income theory. Net income theory is given by David Durant. This is based on the relevance. This says capital structure decisions are relevant to the value of firm. What is this theory actually says? You can see by the diagram. Here is the cost of debt, and this is cost of equity. And the theory is saying here we will take degree of leverage, and here is the cost of various components. The cost of capital will reduce when you will increase the degree of leverage. Okay, in simple words, when you will increase the debt proportion in your capital structure, so by the result, it will reduce your cost of capital, overall cost of capital. So basic, what are the basic? Okay, there are two sources of capital, debt and equity. I have already told you. Firm can change debt equity mix anytime. Cost of debt is less than cost of equity. You can see in the diagram. Firm follows 100% dividend payout. It means 0% retained earnings are here. Business risk is constant over time. There are no taxes, and use of debt does not change risk perception of common investors. So cost of equity remains same at all degree of financial leverage. So these are the basic assumptions of theory. Now you can see how this theory work. Okay, I have already told you this diagram. When you will increase the debt proportion, so it will reduce your overall cost of capital result. Okay, so you can see value of firm is calculated by the value of equity as well as value of debt. So value of firm, we can take the alternate formula EBIT or divided by overall cost of capital, and D is calculated by which formula? Interest upon cost of debt, and E you can calculate by equity earning upon cost of equity. So you can see if you want to calculate the KO means overall cost of capital, you can use this formula KE upon E upon E plus D plus KD upon D upon E plus D. E plus D is nothing, it is the value of firm. So second theory is net operating income theory. This theory is also given by David Durant, but this theory is based on the irrelevance. It means capital structure decisions are the irrelevant to the cost of capital and the value of firm. There is nothing like optimal capital structure. Okay, what are the basic assumptions of this theory? Firstly, there are two sources of capital. Firm can change debt equity mix. Cost of debt is less than cost of equity. Cost of equity increases with every increase in debt. Firm follows 100% dividend payout. Business risk is constant over time. Market here evaluates firm as a whole. Hence, split between debt and equity is irrelevant. There are no taxes. So you can see the diagram of this theory. Cost of debt is also constant here, but when you see here, cost of overall capital is also constant. Why? When you increase the debt, then your cost of overall capital is also constant, or your cost of equity will increase, because if you want to take the advantage of low cost debt, but when you take the low cost debt in your capital structure, it will also increase the risk perception of equity shareholders. That why cost of equity will also increase, and your overall cost of capital will offset the advantage of low cost debt. Okay, so you can see the diagram here. If you want to take the advantage of low cost debt, your overall cost of capital will be constant, because it exactly offset the advantage of low cost debt while the increasing cost of equity. So here is the same formula. Value of firm is equals to E plus D. So E you can calculate by V minus D. Here you can see cost of overall capital can be calculated by the same formula as the previous theory has already explained, but there is a difference of this phenomenon. Okay. Yes. Now the third theory is traditional theory. Traditional theory is given by Ezra Solomon. You can Ezra Solomon. According to this theory, capital structure decisions are relevant to the cost of capital and the value of firm. Firm should strive to reach at the optimal capital structure. Okay, it states that as a result of increase in debt up to certain point, cost of capital comes down and value of firm increases. Beyond that point, reverse trend emerges. So you can see the diagram of this theory. When you increase the cost of debt, so you can see in the starting cost of overall capital is reducing, but when you increase the debt beyond a certain extent, the cost of overall capital will also increase and cost of equity will also increase. So what is your optimal capital structure? At that point, your overall cost of capital is minimum. That is your optimal capital structure. So here you can see there are the three stages in traditional theory. First stage is saying with increase in debt, firm get advantage of low cost debt. Since K is constant, KO decreases and V increases. Second state, further increase in debt leads to increases to equity shareholders, so KE increases and your KO tends to increasing and V is decreasing. V means value of firm. And at the stage third, excessive increase in debt leads to increased KE as well as KD. This results into high overall cost of capital and low value of firm. At optimum point O, KO is minimum, V is maximum. So this is your optimal capital structure. Yes, last theory of the capital structure is Modi-Giuliani Miller theory. Theory is akin to NOI theory. It further elaborates the NOI theory with proper justification and behavioral justification. You can see what this theory is saying. There are various assumptions of this theory. Perfect capital markets. No investor can affect the stock price. Firm can be grouped into equivalent risk classes. As you already know, there are two types of firm, levered as well as unlevered firm. What is the levered firm is where is the debt in its capital structure. Unlevered firm where is there is no debt in its capital structure. Cost of debt is fixed and always lower than the cost of equity. Investors can borrow freely on the terms as the firm can. 100% dividend payout and no taxes are here. Removed later because there are the second approach, approach with taxes also came after that, but you have to focus only when that approach without taxes first one. So what are the propositions? KO and V are independent of capital structure. Increase in debt leads to increased risk to equity holders and increased KE exactly offsetting advantage of low cost. Okay, so this is the same point of NOI approach I have already told you, and the formula is same, value of firm EBIT upon overall cost of capital. They are the various formulas we have discussed previously. Yes, so what is the basically difference between NOI and theory? You can see in this Modi and Miller-Giuliani gives the process of arbitrage. What is this process of arbitrage? It states that investor sells overvalued shares of levered firm and buy the undervalued shares of unlevered firm. This process sets right the discrepancy in the valuation of levered and unlevered firm. You can see firm A is a levered firm. Its overall cost of capital is less, value of firm is more, MPS is also more. So the investor will sell its share and MPS will come down and value of firm will also come down. And firm B is unlevered firm. Its overall cost of capital is more, value of firm is less, MPS is also less. So the investor will buy its share and MPS will grow up. So the value of firm is also there. Substitution of corporate leverage by personal home-made leverage. Okay, it is a proper justification by the It states that investor for equalizing risk in new investment, unlevered firm replicate the debt equity mix of the firm, his personal capacity, and invest total funds, sale proceeds plus loan for maximizing return on investment. This is the justification by approach, which is different from NY approach. So thank you very much. These are all the theories. If there is any doubt, you can write in the comment section. Thank you.